In a bustling seaside town called Portalia, ships from around the world arrived daily, their hulls laden with goods. Traders and merchants thronged the docks, eager to exchange spices, fabrics, and machinery. But there was one challenge they all faced: converting their currencies. The value of the Portalian doubloon compared to other currencies seemed to change every day, and this fluctuation was both an opportunity and a risk. At the heart of this dynamic was the concept of, of exchange rates, the value of one currency relative to another. For Portalia and the rest of the world, exchange rates dictated the price of imports and exports, the flow of capital, and even the livelihoods of traders. Let's meet Anna, a spice merchant from Portalia, and Luca, a textile exporter from a neighboring country, Meridia. One morning, Anna planned to buy silk from Luca. Yesterday, the exchange rate was 1 doubloon for 2 Meridian marks. But today, it had changed to 1 doubloon for 1.8 Meridian marks. This meant Anna needed more doubloons to buy the same amount of silk, making her purchase more expensive. For Anna, this fluctuation was a challenge, but for Luca was a woe wintov fall. His earnings in doubloons increased without selling more silk. Exchange rates, as Anna and Luca discovered, can be influenced by various factors. One key driver is supply and demand. If many traders, like Anna, want to exchange doubloons for Meridian marks, the demand for Meridian marks rises, increasing its value relative to the doubloon. Similarly, if few people want doubloons, its value falls. Another factor is interest rates. Imagine that Portalia's central bank raises its interest rates. Investors worldwide might flock to Portalia to benefit from higher returns on savings or bonds, increasing the demand for doubloons. This would strengthen the doubloon, making it more valuable relative to other currencies. Yet, this strengthening of the doubloon isn't always a blessing. For exporters like Anna, a stronger doubloon makes Portalian goods more expensive in foreign markets, potentially reducing demand for their products. On the other hand, importers like Luca benefit, as a stronger doubloon means they can buy foreign goods more cheaply. To stabilize their currency, Portalia's central bank occasionally intervened in the foreign exchange market. Sometimes it bought doubloons, using foreign reserves to boost demand and strengthen the currency. Other times, it sold doubloons to weaken it, making Portalian goods more competitive abroad. These actions reflected a managed exchange rate system, a middle ground between a completely free-floating exchange rate and a fixed one. Portalia once experimented with a fixed exchange rate, pegging the doubloon to the Meridian mark. For a time, this brought stability, as traders like Anna and Luca always knew the exact value of their currencies. But maintaining the fixed rate required constant intervention. If demand for the doubloon fell, the central bank had to use its reserves to buy doubloons and keep the rate steady. Over time, this became unsustainable, leading Portalia to adopt a more flexible approach. In contrast, Meridia's currency floated freely, with its value determined solely by market forces. This system required less intervention, but came with its own challenges. Unpredictable fluctuations that made planning and budgeting difficult for businesses like Luca's. The town of Portalia also learned that global events could shake its exchange rate. A political crisis in a neighboring country once spooked investors who sought safety in the doubloon, strengthening its value. Conversely, a natural disaster in Portalia weakened the doubloon as traders lost confidence in its economy. Over time, Anna and Luca adapted to the dance of currencies. They began using tools like forward contracts to lock in exchange rates for future transactions, reducing uncertainty. For instance, Anna could agree to buy meridian marks at today's rate, even if the actual exchange wouldn't happen for months. This gave her peace of mind, knowing her costs wouldn't rise unexpectedly. The town also realized the importance of currency appreciation and depreciation. When the doubloon appreciated, imported goods became cheaper, benefiting consumers but hurting exporters. When it depreciated, Portalian goods became more competitive abroad, boosting exports but making imports more expensive. Portalia's experience mirrored that of the global economy, where exchange rates play a pivotal role. Countries like China have historically kept their currency undervalued to boost exports, while nations in the Eurozone use a shared currency, eliminating exchange rate fluctuations within their bloc, but creating challenges for individual countries. In the end, Anna and Luca understood that exchange rates weren't just numbers. They were stories of supply and demand, trust and confidence, and the interconnectedness of global markets. For traders and nations alike, mastering the dance of currencies was essential to thriving in an ever-changing world. The story of Portalia reminds us that exchange rates, though complex, are central to trade, investment, and economic stability. By understanding their dynamics, we can navigate the global marketplace with confidence, turning challenges into opportunities and fostering connections across borders.